Hi, I'm Jimmy. So the stock market is full of big moves higher, followed by the occasional stock market crash. In this video, we're looking at the biggest of all stock market crashes, the 1929 stock market crash that ultimately led to the Great Depression. We're going to look at what the stock market actually did, the actual performance, what led to both the run-up and then ultimately the crash. Okay, so let's jump right in with our quick look at history. So this is a chart of the Dow Jones Industrial Average. We're gradually going to look at what the actual Dow Jones Industrial Average did through the 1929 stock market crash. So throughout World War I, the stock market wasn't exactly great. It didn't perform all that well. But then in 1918, when World War I ended, the economy started to crawl forward again. And during that time, many iconic brands had their start that really helped the economy start moving. One example is in 1921, Lucian Lowe opened a small hardware store that would eventually become today's Lowe's. In 1922, the pharmacy CVS was born. 1923, the Walt Disney Company started when Walt Disney and his brother launched Disney Brothers Studios, that was later renamed to the Walt Disney Company. And then the Roaring '20s happened, and more people started investing. Well, the stock market climbed higher and higher, despite the fact that in the late 1920s, the economy itself wasn't quite as hot as people thought it was or thought it was going to continue to be. The early 20s was quite hot, late 20s, not so much. Yet the stock market continued to climb higher and higher. And as we might expect, the value of many companies that traded on the stock market went a bit nuts at that time as excited investors drove up prices. In 1929, the leading companies of the day, companies like General Electric and the newly formed Chrysler Company, were crazy expensive relative to their profits. Even companies like the Radio Corporation of America, known today as the brand RCA, or companies like AT&T, well, these companies were selling at levels that had not been previously seen. Even in today's standards, these companies would have been considered expensive, again, relative to their profits. So why were things getting so expensive and stock market prices going so high? Besides, of course, irrational excitement. Well, in the 1920s, there was a very important dynamic shift around margin investing. Now, just so we're all on the same page, margin investing is what happens when you put up some cash and you borrow some cash to make an investment. Margin investing really began to see a huge boom in the late 1800s to help finance the railroads that were popping up around the country. But in the 1920s, things changed. At that time, everyday investors began to be allowed to put up just 10% of the capital required to invest in a stock. So let's imagine that we wanted to buy $1,000 worth of stock back at that time. Or $100 worth of stock, it doesn't matter. Whatever the number is, if we wanted to invest $1,000, we only had to put up 100. If we wanted to invest 100, we only had to put up 10. Well, as we can imagine, this made prices shoot up. Banks were lending to almost anybody who had an income. Investors were taking more and more chances investing in anything the stock market had to offer. And then signs of cracking started to become apparent that perhaps the economy wasn't quite as strong as people thought. And in early September of 1929, the stock market then started to turn a little bit lower. And over the next 6 weeks, the stock market gradually dropped about 15%. Now, I know this may not sound like a huge drop, but imagine that many investors of that day borrowed up to 90% of the money that they invested. This means that if they bought at the top and the investment dropped 10%, well, that would mean that all the money that they put up is gone. When it dropped another 5%, well, now they owe that money to their banks or their brokers or whoever they owe the money to. What do people do when that happens? Well, they panic. And just like that, Black Thursday happens. And this is where the pain really starts. So on Black Thursday, there was record-selling volume the amount of shares traded on that day. And the stock market opened, the Dow Jones Industrial Average opened down about 11%. This is on top of the 15% that investors had already lost. Now, at that time, a few big banks and investment companies jumped in and tried to buy a bunch of shares of different stocks to try to prop up the market. But it didn't really help all that much. Over the next few days, it simply didn't matter. Investors were panicking and stocks were crashing hard. And this continued right on through to to the infamous Black Tuesday. On October 29th, 1929, which was Black Tuesday, well, the previous trading volume record that was set on Black Thursday just a few days before was once again broke, with about 16 million shares trading on Black Tuesday. Those numbers were unheard of at that time. Billions of dollars were lost that day, and most investors, if they were still in their stocks, were completely wiped out. Banks were in the hole big time as well. So much of the money that they lent out, by the way, that money that they lent out came from deposits that they had on hand from everyday customers, not from investors, just everyday ordinary people who had accounts with different banks. That money was lent out and gone now. And what we would expect happened did happen. Banks and investment companies began to fail. Everyday people were suddenly hit with the reality that their bank closed because they were out of money. What happened to that money that was in the bank? It looks like they're out of luck. Most of it was gone. This was in the days before banks would have insurance companies or guarantees by the government. In 1929, the FDIC, which insures bank accounts, well, that organization didn't exist back in 1929. It wasn't created for a few years. In 1933, it was created to help prevent the widespread collapse of the country's banks again. Well, at this point, the stock market continues to plunge lower as the country and much of the industrial world slips into a depression. Banks across the entire country failed at a huge rate, hence leading to the creation of the FDIC. Now, the government did what they could to try to revive the economy with very limited success. They lowered interest rates, they tried to get everything ramped back up, but the bottom of the stock market didn't come until about the middle of 1932. And from the top to the bottom of the stock market crash, well, the stocks lost about 90% of their value. Now, I think it's important to point out that although the stock market bottomed in 1932, the economy continued to struggle all the way until 1939, which was, by no coincidence, the start of World War II. Now, there have been many debates as to the official cause of the Great Depression, although it's generally accepted that excessive margins certainly didn't help anything. At the end of the day, many people were financially ruined in the Great Depression, which was largely due to the greed of many investors. That was one of my biggest takeaways as I've studied the history of the Great Depression, is that there was, many times it's presented in history as if everybody was investing, and that's simply not true. There was a group investing, a larger group, sure, than there were 10, 20 years before that, but that group brought down the banking system. The banking system wiped everybody out. The fact that banks were able to go out of business and make people's accounts essentially worthless blows my mind. Now, the country, since that time, the past 100 or so years, have put in a fair amount of fail-safes to try to prevent this from happening. The FDIC, they've increased margin requirements, they've put in rules to try to prevent that type of thing from happening again. But I think that there's many lessons that can be learned from this history. And considering the current level of the stock market, we have to wonder, if the first domino were to fall, how would the government prevent another stock market collapse, given their limited power at this point? Now, I actually did a video not too long ago where I looked at some of which dividend stocks have performed the best during different stock market crashes. So if you're curious, perhaps that's a good next video for you to watch. I got a link right here. I got a link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really appreciate it. Thank you, and I'll see you in the next video.